Welcome back, everyone. We're in the final week of April here, and I just recalibrated my Dividend Aristocrats spreadsheet to tell me which 10 Dividend Aristocrats look the most undervalued right now. I'll get to the list shortly, but before we dive in, I'd like to spend a minute talking about the buy and hold portfolio I am tracking that is built based on these monthly selections. It's really a simple strategy to follow. Each month, I figure out which 10 aristocrats look the most undervalued, and I invest an equal amount of money into each of them. These stocks are never sold, and all dividends are reinvested right back into the issuing stock. I've been tracking this portfolio since August of 2021, giving me an almost 2-year track record. Thus far, it's performing better than Noble, the Dividend Aristocrat ETF, and SPY, the S&P 500 ETF. The total return since inception for this portfolio is 5.42%, compared to 0.61% for Noble and minus 9.3% for SPY. This strategy does go in and out of favor, and it doesn't beat its benchmarks every month. 2023 has started out pretty poorly. My portfolio is up 0.61% through April 27th, while Noble is up 1% and SPY is up 6.15%. I am a patient dividend investor, and I have no trouble sitting idly during these out-of-favor times and waiting for more prosperous periods. I focus on long-term results, and in that respect, this portfolio is performing quite nicely, and I expect that once the strategy returns to favor, alpha will follow. Alright, let's have a look at the 10 most undervalued dividend aristocrats my spreadsheet identified for the month of May. This is an almost fully automated spreadsheet that I share with my Patreon community, and it's designed to analyze all of the current dividend aristocrats using dividend yield theory. The spreadsheet has two tabs, the Summary tab and the Dividend History tab. To work properly, this tool requires the past 12-year dividend history for each aristocrat, which I already have populated and updated as of yesterday. I have this dandy formula down here in row 16 that pulls the most recent annual dividend rate for each ticker, and a formula in row 17 to tell me if the dividend rate for any aristocrat has changed from the value I have in row number 2. The reason I don't automatically update the most recent dividend rate in row number 2 is because the import HTML function doesn't always work nicely. And if it doesn't work, this spreadsheet doesn't work, which I don't like to deal with. Alright, going back to the Summary tab. Here I can run a simple macro that will analyze the past 12 years of trading data for each aristocrat and spit out the final numbers into this table. It'll provide the current price, the fair price, and the over or under valuation based on dividend yield theory. It'll also give me the current and 5-year trailing dividend yield. I also have it set up to run a simple performance test of the average daily return of investing in any given aristocrat every day, only when it appears undervalued or when it appears overvalued. And then we have some dividend growth rates, as well as the 5-year earnings growth forecast, plus an estimated annualized rate of return for the next 5 years, based on the dividend yield, earnings growth, and the return to fair value. I can run this macro any day I want to get the most up-to-date results. I ran it yesterday and made my selections based on the output. I'll filter this file to show me just the 10 most undervalued aristocrats right now. Let's take a closer look at each of the chosen aristocrats for May. I can run the same analysis for each of the stocks by typing the ticker symbol into cell C71, which will update the charts and tables below. Let's start with Ecolab, ticker symbol ECL. The stock currently trades for about $162, and dividend yield theory tells us the fair price should be around $201. This implies the stock may be potentially 19% undervalued right now. Using dividend yield theory as a buy indicator would have worked out favorably for Ecolab. The average daily return for the stock on all days when it was undervalued is 3.65%, whereas the average daily return for all trading days is minus 2.16%. Ecolab doesn't sport an attractive dividend yield, which currently sits at 1.3%, but from a historical perspective, it looks appealing. Dividend growth has cooled off recently, with the last few years seeing rather low dividend increases. But the company did have a handful of nice dividend hikes during last decade. But the last above average increase was in 2019, when the company bumped its dividend by 12.2%. Up next we have Essex Property Trust, ticker symbol ESS. The stock trades for about $206, and dividend yield theory tells us the fair price should be around $298. This implies the stock may be about 31% undervalued today. Dividend yield theory has led to favorable performance results in the 6-year test window here. But in general, Essex Property Trust does not offer appealing returns. Investing in the stock on all days when it appeared to be undervalued led to an average return of minus 0.17%, which is not great, but much better than the average return for all trading days, which is minus 5.6%. Essex Property Trust does offer a good dividend yield of 4.49%, which is almost 1.5% higher than its 5-year trailing average. Dividend growth has been cooling off for this stock, bottoming out in 2021, when the annual dividend was raised by only 0.6% over the prior year. Investors saw a better increase last year of 3.95%, and the current annual dividend rate is 6.33% higher than the annual dividends paid out in 2022. Up next we have Hormel, ticker symbol HRL. The stock trades for about $40, and dividend yield theory gives us a fair price of about $53. This implies a potential 25% undervaluation today. The average daily returns for Hormel during the last 6 years are not impressive, but using dividend yield theory as a buy indicator would have offered a slight improvement. Investing in the stock on all trading days when it appeared undervalued led to an average return of minus 0.55%, compared to an average return of minus 0.67% for all trading days. Hormel offers a decent dividend yield today of 2.76%, but one that is much more appealing than its 5-year trailing average of just 2.07%. The dividend growth history is more appealing compared to the prior two aristocrats. Hormel has generally been a great dividend growth stock, but that attractive double-digit dividend growth rate stopped in 2021. For the past couple of years, the company has been increasing its dividend at around 5 to 6% per year. Seeing double-digit dividend increases is always great, but at 5 to 6%, you're still outpacing long-term inflation. Up next, we have Medtronic, ticker symbol MDT. The stock trades for about $90 today, and dividend yield theory tells us the fair price should be about $115. That implies a potential 22% undervaluation. Using dividend yield theory as a buy indicator has led to better than average returns during the last 6 years. Investing in the stock when it appeared undervalued led to an average daily return of 0.97%, compared to a return of minus 1.78% for all trading days. The current dividend yield is decent at 3.02%. Dividend growth is slowing down, but the company still posted above average increases during the last decade. Up next, we have 3M Company, ticker symbol MMM. The stock trades for about $103, and dividend yield theory gives us a fair price of about $166, which equates to a 38% undervaluation. The last 5+ years have been pretty sour for long-term shareholders, as 3M has not generated any return. Using dividend yield theory as a buy indicator also hasn't led to better than average returns. However, we have to consider that the stock has generally fallen during the last 5 years, and it has hovered in the undervalued zone for the majority of the past 7 years. The company does pay a healthy dividend yield of 5.83%, which is much higher than its 5-year average of just 3.6%. But dividend growth has been almost non-existent for the last 3 years, with just 4-cent increases per year. Up next, we have Nordson, ticker symbol NDSN. The stock trades for about $211, and dividend yield theory gives us a fair price of about $269, which is a 22% undervaluation. Nordson has offered pretty decent average returns during the last 6 years, considering the past year and a half have been rather turbulent. Investing in the stock on all days when it appeared undervalued led to an average return of 9.6%, compared to an average return of 7.58% for all trading days. Nordson is a low dividend yield stock, with the current yield being 1.23%. But what it lacks in terms of yield, the company certainly makes up with dividend growth. During the last decade, the stock has only 1 year, 2020, when it did not raise its dividend by less than 10%. Up next, we have Stanley Black & Decker, ticker symbol SWK. The stock trades for about $77, and dividend yield theory tells us the fair price should be about $146. This implies a potential 47% undervaluation. The stock price has taken a beating since late 2021, and the performance tests support this unfavorable outcome. The average daily return during the 6-year test window is minus 16.69%, and dividend yield theory led to no improvement here. The stock does offer a historically high dividend yield today of 4.14%. Aside from a few days last year, we have not seen such a high dividend yield from this stock during the last 7 years. Dividend growth has been average, with the annual increases ranging from about 3 to 10% during the past decade. Up next, we have T. Rowe Price Group, ticker symbol TROW. The stock trades for about $108, and dividend yield theory gives us a fair price of about $163, which implies a 33% undervaluation. The share price has come down quite a bit from its highs in 2021, and using dividend yield theory would have led to a better than average return during the last 6 years. Investing in the stock on all undervalued days led to an average return of 4.27%, compared to an average return of minus 2.18% for all trading days. The stock pays a generous 4.5% dividend yield today, that is pretty close to its all-time high that was just shy of 5%. Dividend growth has been pretty decent during the last decade, but the most recent increases come in way below par. Up next, we have VF Corporation, ticker symbol VFC. The company did cut its dividend earlier this year, but remains on this list for the time being. The Dividend Aristocrat list is updated once per calendar year, so VF Corporation will remain here until early 2024, at which point it will likely be removed, unless the company can somehow increase its dividends substantially between now and then. The stock trades for about $22, and dividend yield theory tells us its fair price should be about $39, which implies a 43% undervaluation. The average daily return has been awful at minus 25.2%, and using dividend yield theory would have offered a slight improvement to minus 22.73%. Even after the recent dividend cut, the yield is still attractive at 5.39%, but I'd really do my homework on this company before investing. And the last undervalued aristocrat this month is Walgreens, ticker symbol WBA. The stock trades for about $35, and dividend yield theory gives us a fair price of about $49. This implies a potential 29% undervaluation. Walgreens also hasn't generated positive returns during the past 6 years, and using dividend yield theory led to no improvement. The average daily return for all trading days is minus 9.37%, and using dividend yield theory actually led to an even worse average return of minus 9.5%. Dividend growth has also been slowing down, and currently sits at a crawl, with last year's increase being only 1.32%. The only favorable metric here is the current dividend yield that sits at a healthy 5.52%, and is not far off from the recent all-time high just north of 6%. There you have it, these are the 10 most undervalued aristocrats right now. Please keep in mind that just because a stock is undervalued doesn't mean it's a good investment. I think the benefit of looking at the most undervalued aristocrats is that you may find one that you like amongst this list. Of course, you should consider more data than just a simple valuation measure when selecting your investments. Investing doesn't have to be very complex to be effective. As you heard earlier, my very simple buy and hold portfolio targeting just the most undervalued aristocrats has been working out well. I wouldn't suggest for any of you to follow that strategy, as it can very easily be enhanced by applying additional criteria and some qualitative research. The spreadsheet I use to analyze dividend aristocrats each month is shared on my Patreon page. It's an almost fully automated tool that simply requires the dividend history for each aristocrat. It can also easily be retooled to analyze any other dividend stocks. All you need to do is replace any of the aristocrats with whatever stock you want to analyze. Then populate the dividend history and run the macro, or type the ticker into cell C71, and you will have your output in a few seconds. I hope you enjoyed the video. If you did, I would really appreciate if you gave it a like to help me grow this channel. Thank you for watching, and see you next time.